coming off a massive jobs report week with stocks closing at the lows. There's so much to cover. We're going to cover why the markets have moved and what's coming up next week, especially with inflation. But actually, it's going to be brought to you this week by Ryan Littlestone. But before we get to Ryan, I just want to let you all know that this is our 8-year anniversary sale. If you want the lowest prices in Forex analytics, take advantage of the offer that's out today, because most of you know this. The prices, when they're this low, they don't stay that low. And so once it's over, it's over. Also, if you haven't taken advantage of the trader funding program, you want to learn how to access larger amounts of capital, do it right here on traderfundingprogram.com. You can get to it through our website. I'm doing an onboarding one-on-one with individual traders, just like you. If you're new to the assessment process, I'm going to show you what tools are available to you in the Forex analytics community, because you'll get them for a period of time. I'll give you tips on how I passed assessments. So taking an assessment, you'll get a one-on-one with me. So make sure you take advantage of that. And with that being said, take advantage of your time with Ryan Littlestone from Forex Analytics. He's going to guide you through what's happening this next week. Stick around.
Hello traders, well thank you Blake for that introduction, and yes, it's me, Ryan Littlestone, taking you through the week ahead video this week, and coming off quite an amazing Friday, an NFP Friday. We built up all through the week and it was quite explosive when we got there, so that's what I think I'm going to focus on first. Well, where do we start with this one? It was a bit all over the place in the end. So we got the NFP data out. It was a little bit soft on the headline number, but that unemployment rate, which we'd said all last week, is the important number to keep an eye on. That came in lower as expected, 4.2%. So the participation rate stayed unchanged. There was no messing around there. So overall, a little bit of a soft number on the headline number, but jobs are still doing okay. The jobs market is still okay. There's no big collapse in the jobs market. But the reaction to the data was pretty strong, and none more so than in dollar yen. We got a big reaction lower down to, well, that prior low that we had over last month's non-farm payrolls, where the market got a little bit excited. But it'd been a bit up and down in the short term, as you can see. If we're coming to the short-term chart here, we had a big spike up initially when that data dropped, because the market looking at unemployment rate, then we had all the way down, and then it was up and down and up and down all the way through. So as far as the dollar concerned, particularly over non-farm payrolls, I think we got to a point where the market doesn't really know what to do. We've got part of the market still wanting to push for those 50 basis point cuts, still jumping on every bit of negativity it can in the data to push that narrative. And then on the other side, you've got some in the market who look at the data, like I did myself, and thought that's actually not a bad report. That's definitely not 50 basis points type of data. So what do you do when you get a market like that's a bit all over the place? Well, as traders know, you can have all the best laid plans going into a number event, and that's what we did on the various shows and in our chat room during Friday. Get together what assets we were looking at, and then it comes to the crunch and you're looking at the charts and you end up trading something completely different. And I did exactly that in dollar yen. I know I was trading the other side of Blake. He was selling the rallies in dollar yen and I was buying the dips, and fortunately we both managed to make money out of it. But that just shows you that the market really didn't know how to take this data. So what do we need to do when we look at numbers like that, when we look at a market that goes one way 1 minute, then goes one way another minute? You have to look at what assets are really being affected, and the best asset to look at for everything concerning the US is yields. Now, if you look at what happened to yields, we came down. If you look at the 2-year yield, which is quite an important yield, because that's the more shorter term yield that's going to be more affected by interest rate expectations. So this low here, this was the prior low that we got to after that NFP report last month. And also the ISM number, remember that soggy manufacturing jobs number that we got, that got the market all excited, 50 basis points cut, we got that low. We went there again, we broke that low, and now it's just a bit in the balance whether we're going to continue lower. So at least from looking at bonds, you can see what the market wants to do. Now, Again, this was a bit of a strange reaction because although we're seeing this short end yield move and further down the curve, we've seen the yields coming low as well. We saw this all through last week. So it came to the point where, again, if you look at dollar yen, it came off over 500 pips since last Tuesday all the way through to Friday. Now, that happened all through different data points, some data not really important, some data not as bad as feared, like the ISM reports. So when you see yields and the dollar, or particularly something like dollar yen, which is a big follower, moving, irrespective of what's going on in the data, it's not seeing the bounces on reasonable data. You have to know that there's something else going on in the market. And this something is flows, it's big investors, it's big money, and that's going to trump the data. These guys, the big money flows, they don't care about a 25 pip or a 50 pip cut. They're not interested in that. All they're interested in is the longer game. Now, for them, the longer game is getting into bonds, either for buying bonds because yields are going to come down, i.e. the price is going to go up, so they're getting long to make profit on the price, or else they're going to get into bonds to lock in yield. So if yields they can get in yields 3.8%, the Fed's going to get on a hefty cut cycle, then obviously yields are going to come down. Interest rates are going to come down. Therefore, yields are going to drop. So if they're locked in, sitting in money at 3.8, 3.9%, and the yields fall down to 3.5%, they're earning that extra. Now, for big money, small decimal points in yields means a lot. When you're talking billions and billions, even trillions of dollars going into investments like this, the small amount of yields matter. They may not matter to you or me, a difference between 3.6 and 3.5 in something like a 2-year yield, but to big investors, that they're always chasing yield. And they can get half a pip somewhere else, that's what they'll move to. So for me, last week, it showed clearly as we came into the NFP that there's another game going on. And this game is locking in yields and getting long on bonds on the back of Fed rate cuts. Now, as I say, doesn't matter whether those rate cuts are 25 pips the next meeting or 50 pips. It's not really of interest, only that if you're long bonds, you're likely to make a bit more profit on it if it's a 50 pip cut indeed. So when that happens, you have to sort of disentangle yourself from the everyday noise and look at these big flows. Now, we spoke about the dollar. The dollar performed really mixed. So it really wasn't a dollar trade all through last week. We saw, as I said, these yields going. Dollar yen was going. If you look around the yen complex, pretty much every yen pair was seeing downside. I'm just trying to find them on the chart here. So obviously we had dollar yen again coming down to those lows that we saw on the prior NFP report. You've got euro yen, didn't quite get down to those lows, but still some weakness there. So yen strengthening. Pound yen still coming down as well. Again, not quite getting down to those prior lows, but on the way south. Aussie yen, another one coming down. So we've seen this move down in yen pairs, yen strengthening, which is a reflection of what happens in yields. Now, going back to some of the other dollar pairs and how they reacted, if we look at something like euro dollar, pretty steady all in all. We didn't have a big, huge range really throughout the week. Yes, we had the spikes around the data, but we had this move early in the week down to support here, the 38.2 fib, the 110.40 area. Had a little nick under that, but largely it held, came back above, held the level of support again. Then we got to move up through 111. Couldn't really get up to test the prior highs up at 112. And again, for me, that's telling. Even when we're seeing this dollar weakness, these yen, the yields falling, this data that the market isn't liking, despite what the numbers are saying, we couldn't really get up there. And really, we only saw a spike up there before it reverted back to around the 111, 110.80s area. So pretty steady. Again, that's another reason why some of the yen pairs are moving down, but they're not quite getting to their low. So there's a bit of a current movement, if you like, between what's happening in the euro versus the dollar, euro versus the yen. So it's all getting a bit confusing. It sounds confusing to me. And to be honest, on Friday, the latter part of Friday after NFP, the whole market got really confusing because we saw a lot of assets moving. in opposing ways to how you'd expect them to move over this data. So I think going back, as I said, the market is in a bit of a flux. You've got some in the market pushing for these bigger rate cuts by the Fed, and you've got the other side of the market saying, actually, no, the data isn't that bad. 50 basis point cut isn't really justified. So if we go through some of the other pairs, cable as well, another one, it really held up pretty well. If you think that the market is really pushing for those 50 basis point cuts, it's holding up pretty well. We're not seeing really any fresh lows. It's still maintaining this trend that we've had all through August, which was a second leg up in itself. So it's keeping the positivity in there versus the dollar. If we look at something like the Aussie dollar, that suffered a little bit more. Again, you can probably throw the commodities into the mix as well. We did have seen weaker manufacturing data coming in around the globe, and that's not a plus sign for commodities or commodity currencies. And we've seen a little bit of weakness in the commodities as well. So Aussie dollar, that saw a bit more weakness than some of the other dollar pairs. Also, we've got the RBA trade, and I know Blake mentioned this on last week's week ahead video that despite the RBA seemingly talking hawkish, Bullock seemingly talking hawkish, rate hikes are still on the table. The market is seeing something different. It's seeing the data coming in a little bit softer, and so we're seeing a bit more pressure coming in on the Aussie dollar than we are versus, say, the Kiwi dollar. None more so we're seeing that than in Aussie Kiwi, which has continued to have this move, and quite a significant move up from the 111s. Now, this was a trade that I tried when we were having this move back up here, sort of middle of July. I fancied just tapping some shorts up to these levels up here. Unfortunately, I got stopped out pretty much 20 pips below the high. Such is life, and it came all the way back down again. Now, this level down here, the 108, it's a really significant level. It's a massive magnet. Whenever we've been above or below, we have at some point reverted back to this level. As you can see, we've been up and down, all the way around it. And now we're bang on it at the moment. So what I'm going to be looking for here is whether this Aussie dollar is going to continue weakening more so than the Kiwi, whether the RBA are indeed going to switch to a more neutral or even a dovish stance, taking hikes off the table and then reflecting some of the data that they're seeing and maybe hinting that they're going to start to look towards cuts. That's not on the table at the moment from the RBA. If that happens, though, then we're probably going to try the downside of the ranges down here. Somewhere down to the 102s is an area I'll be looking at to maybe fade that move if it gets that far. Conversely, I am still looking to perhaps maybe hit some rallies, but I'm going to be pretty choosy. I want to get some big strong levels, maybe up towards this 110.20 level again. But at the moment, it's not looking that way. But anyway, again, this is just showing that there are other currencies moving in different ways than some of the others. So just a look at Kiwi dollar, just to make the comparison yet again. This one, it's playing nicely with the levels, but it has held up. We've had this big level here, 62.14s. We had the move up to 63s. It came back down. We found resistance after it broke down below again. We've had a little move above. Again, this is all pretty much data driven, but we finished the week below. So this 62.14 level is really shaping up again to be a solid level. If we maintain this hold underneath it, then we're potentially going to go back into range. But for now, if you just take this move off the lows down here back in towards the end of July, it's still maintaining that move. So it's still, at least in the short term, positive for the Kiwi, but it's got to get back above that 62.14 area and push on up. Now, another strange one that's been moving around is also the dollar CAD. We know there's an oil influence, an oil correlation with the Canadian dollar, but really the last few weeks, last few months, it's really been an on-off relationship. 1 minute it's trading what's happening in oil, another minute it's trading what's happening in the Canadian dollar and the Canadian economy, another minute it's trading what's happening in the US dollar. So the correlation really is a bit on and off at the moment. Again, this is another one that hasn't really moved. We've had this big move off of the 139s from the beginning of August. It managed to get a bounce down at level 134s, but it's really sort of taken quite some time to put in a little bit more of a bounce. It hasn't really, taken back much of this move that we saw since August. In fact, it got up on Friday to the underside of this zone, and this was a big support and resistance zone going back for all of this year and further. So when we got this break under, really this was going to be key as to whether we tested it and what happened when we tested it. As you can see, we've tested it, we've held it for now, we're just holding a bit below. So dollar CAD, this level is really the key important level down here. From here, 135.80s up to 136.15s. That's the big area to watch. If we get back above there, you're going to want to see confirmation that it's holding this area again as support. Then maybe we're going to go back up testing 137, 138, maybe even higher. If we stay below this area, then I think it does keep this downside move in play. It does give the momentum to the sellers, and then maybe we get a further test to the downside, maybe even a break and a further move lower. If you're looking at this one from a longer standpoint, there's some really big levels. If we get down to the 132s, 131s, this is really quite a big area. As you see, it's another historical support resistance area. 132s goes all the way down to 131s as well, where we've had plenty of action down here as well. So a big old zone. If we get down there, we're a long way away at the moment, but it's already come 300-400 pips off in August. There's no reason why it can't do a bit more or the same in another month or a few weeks. So don't rule it out. I always like to know my wider ranges when I'm trading. Down to 132 is the edge of one of those ranges, a bit like the 138, high 138s, 139s is the top of the range. Now, I mentioned the yen trades, and obviously one of the others we need to look at is stocks, US stocks. And again, this one went really bonkers on Friday. When we got that NFP data, as I say, I didn't think that it was bad data. And again, we saw a move where stocks actually initially popped higher, and then they reversed, and then they bounced again, and it was a bit of an up and down move that we saw. Now, I had a level down here which looked quite a significant level 54, 40, 50 area down into this 38.2 fib. We just carved through it. In the end, and this happened late on Friday, we'd seen a bit of a bounce, didn't last, it came back down, and then we just carved through. So this is the market again, perhaps saying that they are seeing the jobs market softening, and what that may lead to regarding the economy. Is it going to mean a softening in the economy generally? As I say, some of the data, we have seen some weakness. One of the key points that we saw from some of the PMIs, particularly the respondent comments I saw from the ISM and in the services number that we got, was that although some businesses were saying things were doing okay, others were saying things were not so good, things were slowing down. The key point from a couple of them was that consumer-related services had seen some weakness. So there had been some consumer weakness seen in that. So maybe on Friday the market took it all together, everything that happened during the week, and thought, you know what, we don't like the look of this picture at the moment. We are seeing a weakening. Maybe it's going to be a bit more broad. And obviously now we're seeing stocks down. Levels to look at down here, well, we've got a bit of a key level as well. As you can see, this was a bit of a support point. It was a bit of a resistance point when we were coming up back in June. And when we broke above this 53.90 area, shall we call it, we found it we found it support straight after. And then you can see above that, we made a level here at that 54.40, which is why it was an important one on my chart as well. So as you can see, we've been above there, we've come back down, we've tested this 53, 85, 90, whatever you want to call it, level several times. We've had a break underneath, we've had a move back above. It's one of these levels where we haven't been there for quite some time. It might show up, and it looks like it might have shown up again. The fact that we've closed, pretty much just below it or round about this level does suggest that it's a pretty weak move at the moment. So it's not a level I'll come piling in to suddenly buy against, but going into next week. If we start to see a bit of support building around here, then perhaps that will give longs a bit of an opportunity to maybe take back some of these losses. But otherwise, I think for now, we're probably going to be in a bit of a rally sell mode in stocks. But as you know, 5 minutes later, we could be back up testing the highs. But I just get the feeling again that maybe there's a bit of a flow out of stocks into bonds again, and that's maybe what's driving those yields low as well. A bit of a move to lock in some of that yield, get out some of the high risk, get into some of that sitting in money and just parking up a bit of cash and earning the yield from that. So again, this one, stocks we need to keep an eye on that, what we're going to do at these levels. If we keep going, then really we're going to have to be searching a bit wider on the charts to find our levels for that. Now, oil, as I mentioned for the CAD, that continues to be weakening, and this one really it's back on the bus where we're looking at the fundamentals. We're seeing oil markets continuing to weaken. We're seeing possible production increases from OPEC Plus, which the sources pieces last week were up and down. 1 minute they were potentially going to hike production at their October meeting. Then they saw the oil prices dropping out of bed and decided to come in and put out some stories that they were potentially going to delay that. All the while, we're still seeing weakness in manufacturing. A lot of the PMIs, Europe and around the world, say for the US, are still in contraction mode. And though we saw a bit of improvement over the last couple of weeks, they still remain negative, and that's not good news for oil markets. So we have seen a move down in WTI. Let's put it on a daily chart for you. Bit of a support zone down here. We've been here several times over the last couple of years. It's not a level we've managed to get under and hold under. So we're talking around about 66, 68, and then you've got these couple of extensions here down to sort of the higher 61s. So the start of the support down here, this is really big support. Again, if oil market's going to bounce, these are the sort of levels where it's got to do it. We obviously know that the US is refilling the SPR. We know that they're tendering out for buying more oil to refill that. So as we call it, the bid and bid. So that's something that oil traders may think might start to appear down here. But again, if we don't see much improvement in the data, if we don't see much improvement in the fundamentals, if the US, the market's saying that the US is perhaps heading for a bit more trouble economically than is seen in the data so far, then maybe oil is going to be heading low. And if we get a break of this zone here down at the 66s, then we may be on for a test of those lows down at 61s. Now, I'm keeping an eye on Brent crude because I'm actually trading some longs in this one at the moment. I'm giving this level, this support level, a bit of a go down here, 71, 71 and a half. So I've started some small bits from 72s. It just looks a bit cleaner for me, this level, than it does in WTI, the US oil. So it's just, I don't know, it's an optical thing. It's something I like. If I see a level that really, is respected to almost to the pip, I like that more than seeing sort of little candles, little wicks just below the level or not quite at the level. So this one's a bit cleaner at the moment. 71 and a half. I'm going to trade this down to the 70 buck mark, just that psychological level there. If we break through that 68s then or 69s, then I'm going to get stopped out. But purely from a technical basis, this is one I'm looking at just, as I say, pick up a bit off of support here. Now, another asset that pretty much came through unscathed, where you might have thought, given the moves we had last week, that it was one that was going to maybe bust a move one way or another, and that's gold. And we tried the bottom of this range last week down this 54.80, 54.70. You can take both levels as you like. We held that. We had a move up towards the highs. That came on that data on the NFP, and I was running some buy stops in this one because I'm thinking that if we do get a break higher, it is going to, be quite explosive, and we may be up to 25.50s or even more. So I did run some buy stops, but when I read the data, the NFP, and we were moving up here, I thought, well, this isn't bad data. So I don't want gold to move up on dollar weakness and it just be a spike through on the data. So I pulled my orders. As you can see, we came up here, we held the level, we held these prior highs, we held the main high here, and we've pulled back again to support, and we've held that support. So for now, gold is stuck in this range, which is good in one aspect. If you're trading the range, great, you're getting plenty of ticks in between trading the highs, trading against the lows. But if you're also looking at a break trade, or whether you're looking for next direction, now that we've got over this data, the NFP and all the data last week, if we get a move outside, breaking either up or down, perhaps it's going to be a more tangible move. So it's not going to be perhaps a data spike that might reverse quickly after, going to catch your stops out. If we do get a break, it's going to be because something's changed in the gold market. It's either because the buyers have stepped back in and they thought, right, we've seen all the data, we're happy to be long, we're going to keep increasing our longs now, and then they're going to take it up for a break through the highs, or the market's going to say, you know what, we can't get through these highs, something's going on, we don't really like it. Longs are going to get a bit panicky and think, if we don't break these highs, then maybe we're heading lower. All it takes is a little break down here, 54.70, and you get a lot of people rushing to the exit door. That's when you get a steeper pullback. So depending on whether you want to be short or long, it doesn't really matter. You've got a good range here that we keep testing, and the more times we test it, the more volatile a break is likely to be when it happens. So consider looking at break trades if we head down, or indeed if we head higher. Now, I want to bring up what we've got coming up this week as well, because we do have some events coming up. Where am I going there? So just picking a few items from the calendar. On Monday, we've got some China CPI data and PPI data. CPI has been pretty weak in China. It's expected to come in up 0.7% year on year versus a prior 0.5%. So as you can see there, it's very, very weak with a 0 point on it. If you think everyone else is still up in the 2s and 3s around the globe. So this is almost Japan-like in their inflation numbers, and even Japan's got higher inflation at the moment. Now, this data is important because we heard last week that there may be a possibility of another RRR cut. That's the Reserve Requirement Ratio cut, which is the biggest rate cut, if you like, or the biggest rate announcement that they can make. Because what that does is, the reserve requirement ratio is the amount of cash that banks need to hold on their books for potential emergencies. So they need a buffer of cash. And if the PBOC want that cash to go into work in the economy, then they lower that reserve requirement, which means that those banks can take that cash and put it into the economy. So that's why it's a fairly important rate. So CPI on Monday could be a bit of a decider on whether they push forward with another RRR cut. And if CPI comes in softer, then that's going to raise expectations for that. On Tuesday, we've got some UK data out, the UK labour market report. Now, this one's still a bit of a mess because our ONS, our statistics office, are still messing around trying to get their figures right. They've been messing around with the methodology, and to be honest, I really don't know what they're messing around with. But so some of the data is a little bit wobbly. We don't know whether it's true or not. However, we've got to take the numbers for what they are. The jobs market has shown a little bit of softening over the last 3 months, not massively, but it has come in a little bit weaker. The important gauge we need to look at for this report is going to be the wages data. Now, wages are expected to drop to 4.1% from 4.5% in the last report. That's average weekly earnings. Average weekly earnings, if you strip out bonuses, are expected to come in at 5.1 from 5.4%. Now, these are the numbers that the Bank of England will be looking at very carefully for their upcoming meeting, which is the 19th, I believe. So keep an eye on those numbers. If you're trading the pound particularly, then you're going to see a bit of a move on that. Also, keep an eye on the jobs figure. The 3-month employment numbers expected in 120,000 from a prior 97,000. So, as I say, watch those numbers because it will show whether employment is ticking up or staying steady, or if there's something more amiss with that. On Wednesday, we've got UK GDP, which is the monthly number that comes out. Just keep half an eye on that one. Industrial production, manufacturing production as well at the same time. So give a little bit more information again ahead of that BOE meeting. The big number this week is going to be US CPI on Wednesday, and it's going to add or subtract to what the market's doing with this 25, 50 basis point pendulum trade that we've got going on. CPI is expected to fall to 2.6% from the prior 2.9% year on year, and the all-important core number is expected to come in unchanged at 3.2%. So if we get a big variation for that data, as I say, we're going to play that 25 pip, 50 pip game as well, which, as mentioned at the start of the show, really is more for the short termers to play around with this rather than the long termers and the big money at the moment. On Thursday, it's ECB day, and they're expecting to cut rates as well. In fact, the odds of them cutting according to the market is 98% of cutting rates by 25 basis points. So pretty much a done deal as far as the market is concerned. We know the ECB have started their cut cycle. Likely they cut again this month. The main trade out of this one is what they indicate going forward. Obviously, we'll be listening to Lagarde in the press conference after, and it's going to be, as I say, what are they going to indicate as to the future of rate cuts? Is there going to be a quick follow-up, or are they going to leave it a few months? At the moment, you'd have to say, and some of the ECB heads keep saying as well, they leave in their announcements or their decisions, their movements, their cut movements to meetings that have their updated forecasts. This is a meeting, the September meeting, where we get a set of updated forecasts. The next meeting will be the December meeting when we get those again. So there is a format to be said that they're going to leave rate movements until those forecast meetings. Obviously, if we see different data in between, that's going to get the market moving and adjusting those cuts, whether there's going to be more or less or higher or lower cuts. So that comes in Thursday. In the afternoon or in the US session, we get US PPI data. Again, this one will be feeding off of what happens in the CPI. So if we get a really weak one in the CPI and we get a hot one in the PPI, then you're going to see the market again swinging that pendulum around between the sides of those Fed cuts. And on Friday, we get the flash Michigan number, which sometimes isn't really a big number, but depends, what the market mood is. It's a look at the US consumer, obviously, which is at the moment going to be very important. I think more and more data points, even some of the smaller data points, are going to grow in importance because the market is trying to guess and second guess what the Fed are going to do with these rate cuts and how big these cuts are going to be. So this data could be significant. The headline number, obviously important to see how the US consumer is getting on, but within those numbers as well are the inflation expectation numbers. And those are going to be pretty big for the Fed as well. If they come down significantly, that's going to tell the Fed that consumers are thinking, that we've seen the end of price rises and prices are going to come perhaps a bit lower. That can affect spending habits. You're not going to pay a price a day if you think it's going to be lower in a month's time or a few months' time. That's how central banks look at inflation expectations, because if you think a price is going to be low in a few months, you're not going to spend the money now. That curtails activity, retail sales and the like. So that's why these inflation expectation numbers are very important to central banks. And that concludes everything we've got from the data this week. There's a few other small reports, obviously, to keep an eye on, things like the initial jobless claims, which have done nothing and certainly haven't shown that there's been any big problems in the jobs market. But you never know when they may turn. Things like the NBA mortgage apps and some other data points, some housing data points, NHAB, I think we get this week as well. So anyway, that's what we've got coming from the data. Now, trading wise, and what I'm looking for from anything is really to see if we're going to maintain some of these ranges. And I use gold. I showed gold earlier, and that's a perfect example of when you've got markets that are coming through all this sort of data, all these events, and are still staying in range. That tells you that it's going to take something special to bust us out of those ranges. And we've got, plenty of ranges trading around. Euro dollar as mentioned, we've got this support down here, 110.30s. We know we've got resistance at 112. So we've got all these ranges still playing out at the moment, coming through all that data. Obviously, we've got the central banks coming up, ECB this week, and then we move on to the Fed, Bank of England, Bank of Japan. I think we've still got Bank of Mexico to come. So still a ton more banks to come. And so maybe we have to wait for those to give us a kick out of these ranges. But in the meantime, if you come over the ECB and, euro dollar hasn't made a break either side, then, range trading is the way forward. So that's what I'm looking at this week anyway. Really, it's just going to follow through from last week and see some of these moves. And as I say, whether they continue or whether we're going to go somewhere new. So get your charts ready, plot your levels, know where you'd like to trade, and know where something's going to happen if you're going to move outside of your levels. That's it from me. Thank you for joining us here on the Week Ahead video. Don't forget to join us on the shows, F.A.C.E show, and obviously my Flow show in the morning, European morning. We'll go through all the data and get you set up for the week ahead. So enjoy the rest of your weekend. I hope you have a great trading week this week. See you soon.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.